Certainly seeing a little bit more fun coming through into the Asian equity session, a little bit of risk on given some of the developments in geopolitical tensions we've had overnight. How do you see these tensions evolving from here?
It's been very interesting. I mean, the concerns over tariffs and trade wars were just that, concerns, and valid concerns, but not reality. Even if you take the 200 billion of potential goods which were going to be potentially slapped with a 25% tariff at some point in the future, you're talking less than 0.2% of Chinese GDP and less than 0.1% of US GDP. And yet we had a week where the S&P 500 fell 1.4 trillion in market cap alone. So there was clearly a lot being baked in about a much greater escalation with respect to trade issues and trade wars than the reality. And so hence news we've had overnight about a de-escalation is clearly positive.
Simon, your clients at ultra high net worth, they tend to invest over the longer term. How concerned are they then by these sort of short-term news headlines and the short-term volatility we see in markets?
This year, not so much. We haven't seen panic by any degree. In fact, we've been seeing clients looking to rediversify their investment portfolios and at least year to date take advantage of the weakness. But more broadly in their businesses, we do a monthly survey of around 120 of our largest private entrepreneurial clients in something we call our Industry Leaders Network. And last month when we surveyed them, they were very much looking through the tariff and Trump noise. They believed this was just a negotiating gambit and indeed trade wars wouldn't happen. They were expressing to us the very strong growth they're seeing, particularly in Europe and Asia, and strong demand for both industrials as well as durables, and talking about longer term trends in China. So talking to people about the businesses they own, they were very much looking medium and longer term. They weren't getting caught up in the noise. And what we've seen in terms of clients' investment behaviour, again, using this as an opportunity to re-diversify rather than panicking.
Right, that's really interesting what you say about your clients' own businesses. Are they concerned at all, though, about corporate sentiment in general, that any of this sort of volatility in markets, any of the concerns that could feed through into global growth might affect corporate sentiment and business investment in general, perhaps in the US more than elsewhere?
Well, it's interesting. Comparing this to the start of 2016, when we were talking to our private entrepreneurs and more broadly clients who had stakes or indeed owned significant stakes in public companies, there was a lot more concern about sentiment turning into a real downturn, particularly in the United States. This year, not so much. Be it people's own businesses where they continue to see robust demand and hence were positive with respect to their own sentiment, but also more broadly, very little concern in the client base. And I think it's worth noting, the US ISM this month did fall, however, only fell to the highs of last year. So we haven't seen these headlines play out in broader sentiment. We definitely haven't seen it play out with respect to our clients' own businesses.
Yeah, and as you were saying earlier, your clients looking to diversify rather than panic. How exactly is this diversification playing out?
Yeah, I mean, investing or reallocating to equities, but also looking across the broader credit universe. At the moment, as a house, we have a favourable view on emerging market assets, emerging market equities, emerging market hard currency bonds, and a selection of emerging market FX. And in each of those cases, it's an opportunity with the weakness in markets for clients, again, to rediversify their portfolios and take advantage of much cheaper valuations. And I think that's something worth noting. For all of the concern in markets, we're looking at expectations for first quarter earnings in the US, 18% EPS growth. Even if consensus is met and not beaten, that would be the best reporting season since 2010. And yet it's against a backdrop of trailing PE on the S&P 500 around 16.5, the lowest level in 18 months. Hence the relative buoyancy, I guess, of clients' investment sentiment.
Yeah, it's interesting looking ahead to earnings season. We were showing a chart earlier over how over the past 20 earnings seasons, we were seeing those earnings support further equity gains. Do your clients and do you see earnings this time round doing the same for US and global equities?
We do. I mean, we remain overweight risk assets in general. modestly overweight, and overweight global equities. And again, with all of the concerns about much greater escalation with respect to the trade rhetoric and hence fears rather than reality to date, now actually being able to look at the first quarter earnings of companies and hopefully see robust expectations come through, again against a backdrop of cheaper markets, should be supportive for risk assets.
Simon, I've asked guests again and again because it's important what their view is on the elevated equity volatility versus the subdued volatility we've seen in fixed income and FX. When you look at fixed income, what's your view here? Do you prefer the short end? Do you prefer the long end?
Well, I think on your point on volatility, it's an interesting one. First of all, when we talk about elevated equity volatility in the current situation, it's only elevated versus the extraordinary situation we had in the 18 months up until the end of January. In fact, the volatility we're seeing currently is normal equity volatility. You put that against a backdrop of rates and fixed income volatility more broadly, I take your point that we haven't seen spikes there. However, I think that's for good reason. And the good reason being, for all of the concerns over trade wars and tariffs, there have not been any fundamental impacts on the economy. So when you looked at relatively elevated and stretched sentiment and positioning with respect to equity markets as we came through to February, it makes some sense that there would be jitters and heightened volatility with respect to this news. When it comes to rates and fixed income, the lack of a fundamental impact, I think, also explains why we haven't seen that volatility flow over.
Yeah, and it's interesting because equity markets might be focusing more on sort of trade tensions in the short term, whereas the fixed income market focused on fundamentals, central bank policy. Of course, we could talk about the central bank reaction function to everything that's happened. But I just simply want to ask, and I completely take your point and know that equity volatility is at more normal levels now. Does that mean then that fixed income volatility rises to match it? Or with the signaling from the Fed, for example, so clear, is the 10-year yield simply going to drift higher from here?
Well, we still have JGB 10-year yields being anchored by the Bank of Japan and extraordinary monetary policy. When you look in Europe, there's still continued quantitative easing as well as negative front-end rates. So it really is the United States that is trying to normalise policy as we currently stand. And as you say, with the signalling, very clear 3 further rates expected this year, which is market consensus, and a steady path into 2019. Our expectation is within rates markets, volatility will remain relatively subdued.